Hey, before you get started, hit that subscribe button. Oh, hit that like button too. Thank you. All support is welcome. If you need to, hit the pause button on the video and write down our Cash App information and show us some love. We appreciate it. This helps our team produce more and more helpful content. Thank you. Woo-wee! You know what that whistle means. It's game time. Let's get it. I really got a good one for you today. All right. I really want to give you some origin of how the stock market came about, some basic fundamental understanding of how it works and how it used to work and how it works currently. Okay. All right. That's very important to know. And as you can tell, I don't always just try to talk specifically about a certain topic. I try to impart knowledge on how to better acquire information and knowledge. Okay, so this first clip, it's going to really give you the fundamentals of the stock market. And in everything you do, you definitely have to have fundamentals. Here we go.
In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, and silks around the globe. But running this massive operation wasn't cheap. In order to fund their expensive voyages, the company turned to private citizens, individuals who could invest money to support the trip in exchange for a share of the ship's profits. This practice allowed the company to afford even grander voyages, increasing profits for both themselves and their savvy investors. Selling these shares in coffee houses and shipping ports across the continent, the Dutch East India Company unknowingly invented the world's first stock market. Since then, companies have been collecting funds from willing investors to support all kinds of businesses. And today, the stock market has schools, careers, and even whole television channels dedicated to understanding it. But the modern stock market is significantly more complicated than its original incarnation. So how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the company will advertise itself to big investors. If they think the company is a good idea, they get the first crack at investing and then sponsor the company's initial public offering, or IPO. This launches the company onto the official public market, where any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owners in the business. Their investment helps the company to grow, and as it becomes more successful, more buyers may see potential and start buying stocks. As demand for those stocks increases, so does their price, increasing the cost for prospective buyers and raising the value of the company's stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they'll sell their stocks with the hopes of making a profit before the company loses more value. As stocks are sold and demand for the stock goes down, the stock price falls, and with it, the company's market value. This can leave investors with big losses, unless the company starts to look profitable again. This seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces, such as the fluctuating price of materials, changes in production technology, and the shifting costs of labor. Investors may be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. And of course, plenty of investors are simply ready to sell valuable stocks and pursue personal interests. All these variables cause day-to-day noise in the market, which can make companies appear more or less successful. And in the stock market, appearing to lose value often leads to losing investors, and in turn, losing actual value. Human confidence in the market has the power to trigger everything from economic booms to financial crises. And this difficult to track variable is why most professionals promote reliable long-term investing over trying to make quick cash. However, experts are constantly building tools in efforts to increase their chances of success in this highly unpredictable system. But the stock market is not just for the rich and powerful. With the dawn of the internet, everyday investors can buy stocks in many of the exact same ways a large investor would. And as more people educate themselves about this complex system, they too can trade stocks, support the businesses they believe in, and pursue their financial goals. The first step is getting invested.
Okay, now, let's get ready to take some notes. Organize, structure, discipline. Here we go. First plan of action. You need to find a platform. You need to connect your bank account. Determine an initial investment. Determine your strategy. Learn how to place a trade. And then place the trade. Okay, when it comes to finding a platform, I recommend venues such as Robinhood, Webull, Cash App, platforms of that nature. So that's what I mean when I say find a platform. So this is basically telling you to find a venue in order to actually make your trades. There are other platforms to utilize. However, I like to recommend these based on ease of use. For a beginner or someone who is new to these types of platforms, I think the ease of use for conducting transactions is much simpler, and that's the reason why I recommend some of these platforms. Once you get set up within a platform, it will typically give you directions and instructions on how to connect your bank account. That's very important in order to transfer your money in and transfer your money out. I know a lot of people get concerned about how quickly they can get their money and how much access they do have. It's pretty easy and simple to get your money in and out of your bank account. Sometimes there may be a 1 or 2 day hold based on ACH rules and things of that nature. But for the most part, it's pretty simple and easy to acquire access to your funds. A big question that I get a lot is, how much should I start with? Well, you should start with something that's comfortable, but will also maintain your interest. If it's only a amount of money that you're not really interested in, and you make some significant gains based on percentage, then you're not going to pay attention. So let's do something that is not too much that will have you stressed out, but just enough to pique your interest as you make money. And as you make money, then add more to it as you go and continually compound on what you have in there and the profit that you've made. And remember, this is very important. This is a long-term thing. It's a marathon, not a sprint. Now, you may have times where you make some fast cash and a quick profit. However, there also are times where it might take a spike down and you lose a little bit of money, but the long-term goal is to make money over a long-term period of time. I really want to reiterate that I'm giving you the fundamentals of a lot of this terminology. I'm telling you this so that you understand that this thing can be far more intricate. But again, you can know the fundamentals and start to invest and start to make money, because the longer you wait, the longer you cost yourself. Let's talk about stock strategy. Okay. It's very important to have a strategy before you start to buy your stocks. Okay. Your age makes a difference. The younger you are, the more riskier you can be. The older you are, the more conservative you may want to be. You need to understand technical and fundamental analysis. That's very important. Keep in mind that technical and fundamental analysis can become far, far more intricate. However, you can grab a hold to the basics and still make great decisions and make good money. So let's talk diversification for a moment. Many use diversification of their stocks as a safety net in order to balance out overall risk. For example, let's say you're invested in the tech sector and you have one stock that's down heavily, and then you look at another sector such as retail and you may have a stock that's up substantially. And what will happen is when you have certain down days in particular sectors or particular types of stocks, you might simultaneously have up days in another sector and their types of stock. This in turn creates a balance of risk. And if you notice, I've introduced the word sector. That's some terminology that you need to research and understand. Sectors represent different types of groups of stock. For example, you might have the tech sector, or you might have the consumer discretionary sector, or the communications sector. It's important to understand the different sectors because many times larger organizations invest according to sector, or people in general invest according to sector. So let's talk about what products and services you buy and support. For example, if you have a cell phone with AT&T, then you may want to buy AT&T stock. If you shop at Walmart, then you may want to buy Walmart stock. It is commonly understood as a strategy to buy what you buy. So again, wherever you shop, wherever you buy service, you may want to support that stock. It makes sense to invest in the companies where you purchase products and services. The thought behind that is if you're buying there, then other people are buying there too. So it may be a good company. It may last for a long time. These are the traits that you're looking for when you purchase particular stocks. You want that particular company to have a sound business plan, and you want that company to be one of longevity. So you need to sit down, make a list of all the companies that you buy from, determine what their stock symbol is, and use that as a potential part of your strategy. Now let's talk about dividends. There are certain stocks that pay more dividends than others. Some stocks don't pay any dividends. Typically, those are viewed as growth stocks. But however, we want to talk about dividend stocks. Again, there are certain stocks that have been around for a long time and some not as long, but they pay better dividends than others. Dividends are amounts of money paid to you as a stockholder for investing in that particular stock. Typically, when you're dealing with dividend stocks, they don't necessarily fluctuate in price as much. But the beautiful thing is you're still getting paid for owning that stock. So some people look at that more as a consistent and conservative, solid investment. So it's very important to understand and know the different types of dividend stocks. Let's talk about growth potential. Some stocks are like dividend stocks, like we just mentioned, but some stocks are what you call growth stocks. And they don't pay dividends where they are anticipating the price of the stock to grow at a rate where they don't feel they need to pay anyone dividends. For example, let's say you have stock A and it's growing at a rate of 15% for the year. Okay. And then you have stock B and it's growing at a rate of 60% for the year. Stock A may pay dividends along the way, where stock B doesn't feel like it needs to pay dividends because the growth rate is so good that you're making money based solely on the growth, which is the price of the stock. So be sure to make a list of stocks that you feel have the greatest growth potential for the future. Those who make the best decisions on these kind of moves usually make a lot of money. Next up, last but not least, is quantitative analysis. This is where you examine the financials of a company and you examine such statistics as PE ratio, which is price to earnings ratio. You study the financials of the company, the profits, the losses, the expenses, things of that nature. This is very important. The more you know about the books of a company and what kind of profit margins they have, the better decisions you can make about how well a company may do in the future. This is also how people find bargains. If you investigate the books of a company and you find out they're doing pretty good, you find out they're making a lot of profit and nobody's talking about it, then you may want to jump on the train before everybody finds out and the price blows up. All this information is right out there to be learned, viewed, discovered, however you want to look at it. There are a number of sites that you can go in and type in a stock symbol, and it'll show you all the valuation information of a company. I know what some of you are thinking. This seems like a lot of information. I don't know if I could keep up with it. Trust me, you can absolutely do it. There's no need to worry. The information is out there. You can make decisions and learn along the way. Again, the longer you wait, the more you lose. Plus, you can just stay tuned into the channel, and I'll be putting out more videos about the details of each of these categories that we just discussed. So don't even worry about that. Next up, learn how to place the trade or enter the order for the trade. Okay. Some people call it placing the trade. Some people call it entering the order. All right. You need to learn in your platform how to efficiently and effectively place the order that you want to place. That is very important. You need to understand bid and ask. You need to understand the current price of the stock. You need to understand volume. You need to understand the technical aspects of actually executing the trade within your platform. We'll be putting out a tutorial to show you how to place orders for stocks as well. Learning how to efficiently and effectively place orders can save and make you a lot of money. The next thing we want to focus on is actually placing the trade. Sometimes starting something is the main thing that gets you going. You just need to start. So you need to get in there, do all these things we just talked about, and actually place your trade. Come on, let's get it. Okay, now that you got the plan, what you gonna do? You gonna pass? You gonna dribble? Or you gonna actually shoot for a change? Okay, in this next segment, I want to give you a little clip from one of the greatest investors of all time, Warren Buffett. He's by far one of the greatest to do it. Let's pay close attention to what he has to say and see if we can pick up on some knowledge. Let's get it.
I had started investing when I was 11. I just dithered away until when I was 7 and 8 and 9. So unfortunately, I didn't get started until I was 11. But I bought my first stock when I was 11, and then I experimented with a whole bunch of things, the timing of stocks and charting and doing all these crazy things. It was a lot of fun. Profitless, but a lot of fun. And I did that until I was 19. And I read all the books on investing in the public library and I ate it up. It was fascinating to me, but I had no framework. I was just searching for something. I was hoping that little things on a chart would tell me something about what a stock was going to do. It was kind of crazy, but everybody else was doing it, so I figured I'd do it too. Sometimes you'd turn the chart upside down, it still wouldn't help. Then in 1949, I read The Intelligent Investor by Ben Graham. I'd never heard of him up till then. And there are really only 2 chapters in that book that are the key to it. But they set my philosophical framework for investing in 3 ways. They're so basic and so simple, it's hard to understand how they could be that important, but the 10 Commandments are simple. The first is,
it's not easy being the one everyone counts on to keep your operation running. That's why at Grainger, we're here for you with professional-grade industrial supplies and fast delivery. Call, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
that a stock is part of a business. I mean, you can't think of a stock as something different. You value a business, and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12 the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards at Harris Upham, but I didn't know anything. I mean, I knew that X was U.S. Steel and T was AT&T and so on, but I didn't know anything. I didn't know what was behind them. So I had to start looking at these little symbols or these little names in the paper as businesses and decide, how do you value a business? What counts? The second thing in the book is that Graham gives you a marvelous set point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in chapter 8. And there's been no better thing written in terms of the investor's attitude toward stock prices. Most people react the wrong way to stock prices. I mean, they feel good when their stocks go up, they feel bad when they go down. They think the stock market is there to instruct them. And Mr. Market is this partner you have in investing. You know, he's a remarkably obliging partner. This guy comes around every day and he tells you what he'll pay you for your interest in the business or what he'll sell you more at the same price. Nobody ever does that in private business. If you and I owned a gas station together, and I said, every day I want you to come in and offer me your half interest in the station, and I can either buy your half or sell you my half at the same price, and you have to come in every day and do it, you'd be at a terrible disadvantage. And you'd be at a particular disadvantage if you're Mr. Market in the market, because Mr. Market, our friend in the market, who obligingly gives you those figures every day, different figures at the end of the day and the start of the day, but he's naming a price at which you'll either buy or sell. The beautiful thing about him is that this guy is an alcoholic manic depressive. I mean, he is as unsound as they come. He wanders around all day, and looks at the crazy things, and he's going to name all kinds of crazy prices. And you don't have to pay any attention to him, except when it's to your advantage to do so. If that's once a year, if it's once every 5 years, it's one stock out of 3,000. All you have to do is sit there. You have no moral responsibility to this jerk. He is naming these numbers. You didn't ask him to, but he's doing it. And all you have to do is pick the one time when he is particularly depressed or particularly manic or particularly drunk or whatever it may be. And the market will be all of those things. And you take advantage of it. And that's what's remarkable about stocks, if you think about it, is that if you look at the high and low on all of these American companies for the last year, you'll see case after case after case where the high is twice the low. Now that's for a sound American business, is running along, paying people, selling goods, and so on. If you go out and look at farmland 10 miles from here, there's no way in the world over a year that the farmland is going to range in value from X to 2X. It maybe go from X to 110% of X or vice versa. If you look at an apartment house near here and figures on essentially apartment houses like that over a year, it won't move 10% in a given year. But here are the finest of American businesses, and people just name these numbers that go all over the place. And you don't have to play, except when you want to. That's the important thing, and that's what Graham tells you. The market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to serve you. One of the most important things to remember in stocks, very hard to do, but people have all these feelings about it. The stock doesn't know you own it. You're sitting there with these certificates for Berkshire. The company doesn't even know you own it, and the stock doesn't. It's trading now, and they don't know you own it. So it has no feelings about you. I mean, you've got all these feelings about it, but it's just part of a business. If Berkshire is worth 75,000 times 1.5 million shares, roughly 110 billion or something like that, it's a good investment. If it isn't, it's a lousy investment, and you have to value the business. And Graham, it's amazing, but people don't do that in Wall Street. You hear price targets or that kind of thing, but you'd see no one write a paper that says, here's the nature of this business over the next 20 years. What should that business sell for? Forget about what it's selling for. In fact, one of the things I always like to do when I'm looking at investments is I like to look at them without knowing the price. Because if you see the price, it automatically has some influence on you. If you just sit down with the reports, if I get an idea about looking up a company and I get the 10Ks and so on, I would rather not know the price because I'd rather value it without knowing the price. When I used to handicap horses when I was a kid, one of the things I would do is I'd get the racing form ahead of time. And if there were 9 horses in a race, we'll say, obviously the probabilities of each one winning the race had to add up to 100%. I mean, one horse was going to win the race absent a dead heat or all of them dropping dead on the backstretch. So if you went through the racing form and I would look at the third race at Hialeah, I would try to figure out the percentage chance of each horse winning the race, and that had to add to 100%. Then I would compare those percentages to the odds. But first of all, I wouldn't look at the odds first. I would look at the past performance and all of that thing first. Stock market's the same way. Third thing in Graham's book is the margin of safety. If you come up to a bridge and it says capacity 10,000 pounds and you're driving a 9,800 pound truck, you drive down further and find another bridge. I mean, nobody knows exactly what that capacity is, and sign may have been put up 3 years ago. So you always leave a margin of safety. You don't try to cut things that close. You wait till something kind of shouts at you in the stock market. And with those 3 principles, you can build all kinds of all kinds of structures on that. But that's the foundation. And if you've got that in mind, and that's in the intelligent investor, I've never found anything that remotely compares with it. All three of the ones you can't get rid of one leg of the three-legged stool and still have a good investment philosophy. But I would say that the most important thing over a long period and working with big money is to understand the business. Let's just say for the moment that you were given $1 million or whatever sum was necessary, and you could look around Knoxville or look around all of Tennessee if you want and buy into any three businesses, between now and a week from now, private businesses, not trading or anything of the sort. And you got a week to do it or you have to give the money back. What will you be doing during the next week? I mean, you can look at all these companies. Some of them you're quite familiar with. Some of them you're less familiar with. Some of them you know by reputation. Some of them you know the management. Some of them you don't. You know their competitive situation. What will you be thinking about during that 7-day period? How will you actually be screening these companies out? I think you'll look for three businesses, and you can't trade them after you buy them. You're gonna own them the rest of your life. You're gonna be looking for businesses that have enduring competitive advantage. You don't want to buy a Burger King franchise just because nobody's come within 10 miles of it yet, because Wendy's and McDonald's and all of those will be there pretty soon. I mean, it isn't necessarily who's earning the most money now. You're going to look for something with enduring competitive advantage. Now that takes a business with some kind of a moat around it, because capitalism, by definition, is a system where every time somebody has an economic castle, somebody else is going to come after it. It's just the nature. If you open a restaurant and it's successful here in town, somebody's going to take your menu and probably take your chef, maybe cut your price, maybe offer a little more parking, maybe be a better okay, whatever. I mean, capitalism consists of going after the other guy's castle. If that's the case, you want a castle with a big moat around it. And there's a lot of ways you can have a moat around something. You could have it by patent protection. You could have it by location in certain areas. I mean, if you have something in people's mind, like Coca-Cola, 6 billion people in the world, practically all of them have something in their mind about Coca-Cola, largely favorable. They don't have anything in their mind about RC Cola. And if RC Cola spent $1 billion advertising, they wouldn't have anything in their mind about RC Cola. But they've got something in their mind about Coke, and generally it's favorable. That's why Coke wants to be where people are happy, because they want to be at the theater. They want to be at Disney World. They want to be at the World Series. They want always have you drinking that drink of Coca-Cola while at the same time experiencing happiness. And if they do that, they're going to sell a lot of Coca-Cola. And it won't make any difference if somebody is a half a cent less on some serving than Coke. So that's an enduring competitive advantage. And you want it run by honest and able people. You don't want to go in with a crook, and you don't want to go in with a dope. Now, the best businesses to buy are the ones where you could have a dope in there. I mean, Peter Lynch says, buy a business that's so good that an idiot can run it, because sooner or later one will. And there's some merit to that. In fact, I got a question the other day from a student group, and they said, what's going to happen to Berkshire when you go gaga? And I said, well, Berkshire's so good that I can go gaga. In fact, I may even be. Those are the kind of businesses to own. So you want a management that's able and honest, and then you want a price that's sensible. And that's what you'd look for. You'd go around Tennessee, got a week to do it, and you'd immediately screen out a whole bunch of things. You just know that they weren't a fertile area. That's an important thing to be able to do, to know, just get rid of all kinds of things. There was a great article in the New Yorker 30 years ago when Bobby Fischer was playing Spassky in a famous chess match which drew attention around the world. And they examined how the mind could, with billions and billions and billions of possibilities, how it could group things so as to immediately cast it down to where you had like 4 options. And of course, when the humans play something like deep thought, or whatever the latest version is of the computer on that computer is making maybe 700,000 or 1 million calculations a second. And the human mind is competing against that, but the computer is checking every possibility. And the human mind somehow has this ability to cast out 99.999% of those things that the computer has to go through in order to focus on the 3 or 4 possibilities that really make sense. And investing's a lot like that. It's not that tough, because there aren't that many companies, but you want to cast out all kinds of things. If somebody told me that my life depended on picking among the Dow Jones stocks a group of 10 that would be the best performers or outperform the index as a whole, I would spend my time thinking of the worst companies in there. I would cast out things, and then I would figure I left those behind, and that's an easier way to approach the problem. actually, than trying to pick the 10 best. If you were thinking about the state of Tennessee, there's a whole lot of things you wouldn't examine. You just figure they're too tough. You might decide, car dealerships were too tough. It's always going to be competitive. Who knows whether Ford or General Motors are going to be selling more cars 5 years from now, or whether there's going to be tariffs on foreign cars. Who knows? So you just say, I'll give up on car dealers. I'll think about something else. And that approach that you use there is the same approach you really want to bring to the stock market. You've got 3,000 companies tonight you can look at on the New York Stock Exchange. There's a valuation on every one of them. It'll change tomorrow. You don't have to play. Once a year, if you have 5 good ideas in your lifetime, you get very rich. I tell students sometimes they'd be better off if they had a punch card when they got out of school with only 20 punches on it. Because then, instead of listening to somebody at a cocktail party and then going out the next morning and buying some shares, they'd really think about every punch. That's all the punches you get. 20 punches is plenty. You just have to make sure that you don't do any of them for frivolous reasons. We never want to buy anything small at Berkshire. It just doesn't make any difference. We want to think about things that can move the needle. And that gets tougher as the capital gets greater. But that's the way to focus on investment.
Thank you for tuning in. Don't forget to take good notes. Be sure to get you a plan of action and then make it happen. We appreciate you. We look forward to seeing you soon. Stay tuned. We got some great things coming down the pipe. Let's get it.